Greetings, everyone. Welcome to Liberty Call. Today is Wednesday, February 8th, 2023. Hope everybody's having a fantastical day out there in the interwebs. For whatever reason, Facebook's not syncing up, so I'm going to have to upload this later on after I finish up the recording. So if anyone's watching this on Facebook, it's not live anymore. Sorry. So, all right, not the most beautiful day in the markets. The three major indexes here domestically were in the red all day long, but again, there's several. I saw several quotes here on the boob tube earlier that a lot of the Fed governors were talking about how interest rates are going to have to stay high, and that's probably a lot of why the market took such a dump today. That everyone was freaking out because they're hoping that with the slowdown in rate increases, that hey, we're going to turn tail and start lowering rates again, so that we can get all that cheap money, but I just don't see that happening. So, alrighty. Well, if it's your first time watching, give me some thumbs up, likes, shares, subscribes. I greatly appreciate it. Let's go ahead and jump into the numbers for today. The Dow Jones was down 0.61, closed at 33,949. S&P 500 was down 1.11%, closed at 4117. NASDAQ was down 1.68, closed at 11,910. Small caps were down 1.39. VIX up 5.2%. It's currently at 1963. Canada was in the red by 0.22%. Brazil up 1.97%. Mexico down 0.39%. The European markets, Germany was up 0.6%. UK up 0.26%. France down 0.18%. Euro stocks was flat at 0. Netherlands was down 0.62%. Spain up 0.6%. Italy up 0.15%. Switzerland up 0.38%. And Portugal down 0.34%. So kind of a mixed market there in Western Europe. Both Russian exchanges were red. MOEX was down 0.69. RTSI down 2.25. And the overnights in Asia, see a lot of red there too. Japan was down 0.29. Australia up 0.35. A lot of red in China. The Shanghai was down 0.49. DSA component down 0.62. China A50 down 0.41. DJ Shanghai down 0.49. Hang Seng down 0.07. And the Taiwan weighted, one of the few bright spots in Asia, was up 1.41% for the day. All righty. So that's all the markets for trading day 2/8. Let's take a look at today's market recap, see what they had to say here. S&P 500 takes hit from Google rout. Hawkish Fed speaks. All right, let me grab my notes here. The S&P 500 faced a decline on Wednesday as tech stocks were hit by a blow from Google. The search giant recently held an event to promote the launch of its new AI chatbot, Bard, B-A-R-D. However, just before the event, the chatbot reportedly delivered inaccurate answers in an advertisement, which led to negative sentiment towards the company. Google has since stated that it will use extreme external feedback and its own testing to ensure that the quality and accuracy of Bard's responses. Meanwhile, continued remarks from the Federal Reserve officials about higher interest rates for longer to curb inflation added to the negative sentiment on tech stocks. Apple, Amazon, and Meta platforms were among the tech stocks that saw losses, while Microsoft remained flat due to its plans to integrate ChatGPT into its search engine Bing. On the earnings front, Uber Technologies reported a surprise Q4 profit and positive guidance, which led to a 6% increase in its stock. Chipotle reported weaker than expected Q4 results, which resulted in a 5% decrease in its stock. Under Armour beat expectations in its quarterly results, but its shares fell 10% as promotional activity is expected to continue to affect gross margins and inventory growth. The energy sector was also pressured by a decline in APA Corporation, EQT Corporation, and Chevron, although higher oil prices and a stronger dollar helped limit those losses. All right, well, that's everything for the market recap. I have some news here about U.S. wholesale inventories post smallest gain in 2.5 years, and sales are muted. That doesn't sound good. The Commerce Department released data showing a slight increase in wholesale inventories in December, growing by 0.1% as previously reported. The growth was driven by a rise in wholesale stocks of motor vehicles and electrical equipment, but saw decreases in furniture, computers, professional equipment, apparel, farm products, petroleum, and paper. The accumulation of inventories in the fourth quarter is considered a warning sign for the economy, and it suggests a slowdown in domestic demand and may result in a liquidation of unsold goods that could tip the economy into recession. well, maybe not so bad if you've been sitting on dry powder. You can scoop up a lot of good deals. So, glass is half full, glass is half empty. So it depends on which side of the trade you're on. Wholesale sales remained unchanged in December and have been softening since last July, with notable decreases in sales of apparel, alcohol, petroleum, and chemicals. The inventories to sales ratio remained at 1.36 months, the highest since June of 2020. So again, more news that just things are kind of slowly deteriorating. It's not an immediate collapse, but it never is. I mean, I think back to 2007 and 8 and 9. And I mean, it was kind of a slow, gradual descent in 2007, and then things really started to pick up steam in 2008, and then the bottom fell out at the bottom of 08 and the beginning of 09. So it could move slowly until it doesn't. That's kind of the way things work. All right. One last article here, the avoidable retirement mistake that empty nesters make. So let's go ahead and let me bring in my notes and we can go through this article. According to a recent study by the Center for Retirement Research at Boston College, empty nester parents may be falling behind on their retirement savings goals after their children leave home. The study aimed to examine how empty nester parents adjust their savings, consumption, and earnings after children leave the house, and to reconcile the inconsistencies between previous studies that showed both reduced consumption and increased savings, and studies that showed no increase in savings. The study found that empty nester parents tend to work less and earn about $2,000 less per year after children no longer live with them. Despite a decrease in consumption, net worth remained unchanged, leading to questions about why these parents aren't saving more. And, side note here, I remember seeing something last week on some of the business channels that I think 24% of millennials have their rent paid by their parents, which millennials were born between 1980 and 1995 or 6. So that's about a 15-year span. So those people are now 43 to, 95 is. So they're all to almost 30. These people should not be having their rent paid by their parents. I mean, come on, people, it's just get off your ass and get to work. I mean, it's crazy. Anyway, jumping back in, there are several potential reasons for this trend, including a reduction in nominal income. If someone normally contributes $2,000 per year to retirement and begins earning $2,000 less annually, they may forego saving that $2,000 altogether, even if they're consuming less overall. Empty nester parents who decide to work less and support children who have left home will also have less money to save for retirement. See what we just talked about? As will parents who choose to pay down debts more quickly after their children have left. It's important to keep your retirement goals in mind and make sure you're staying on top of savings, even if after your children have left home. A financial advisor can help you keep on track, but it's also important to be aware of the potential pitfalls that may arise. The study highlights the importance of consistent and deliberate saving for retirement, as it is a marathon and not a sprint. And let me get down here to 3 of the actionable items that empty nesters can take. Number 1, maximize your IRA or 401k. Retirement planning often starts at work. If you have access to a 401k or similar workplace retirement plan, use it. A recent study from Vanguard says that roughly 1/3 or 34% of Americans are leaving free money on the table by not saving or by saving below the employee match. Empty nesters over 50 can make catch-up contributions too. So it's like usually an extra $5,000 or $6,000 you can put into your 401k. Number 2, put money aside. Put money into a health savings account. An HSA lets you invest money for future medical expenses while getting special tax breaks. Your contributions reduce your taxable income, and your money grows tax-free. In January of 21, there were Some people need to proofread their work here. There was $82.2 billion was invested in 30 million HSA accounts. This was 25% year-over-year jump in assets and a 6% jump in total accounts. Next up, guarantee an additional income stream with an annuity. Annuities are insurance products that pay out the full amount of principal and interest over a specific period of time. You can delay taxes on earnings and sometimes extend it to beneficiaries. An annuity could also allow you to take Social Security benefits at a later age and therefore maximize your benefit. A financial advisor can help you invest your money, blah, blah, blah. And lastly, delay your Social Security benefits until age 70. Waiting until full retirement age will allow you to get 100% of your retirement benefits. However, by retiring at age 70, you could get 132% of your regular monthly benefit amount. So while you will get fewer Social Security benefit checks in your lifetime, they would be 1/3 larger. And so you have to kind of do a graph showing, all right, if you start taking money at 62 versus full retirement age, 65 to 67, and then, or if you delay to the maximum age of 70, and you just, show those charts, show the break, where the crossover points are from, earliest, mid, and then latest. And then, typically I just ask my clients, what do you want to do? How long do you think you're going to live? How long did your parents live? That's typically how you make that decision. But earning more or getting more money from the government before they run out is never a bad idea. So, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. And I hope everyone has a wonderful evening. I will talk to you guys next time. Adios.